Many of you are asking, can I actually borrow money from my whole life policy? And how does that actually work? How do I access the money? Do I have to pay for it? Do I have to pay payments? What's the do's and the don'ts with this? That's exactly what I'm going to cover today in this video is how do you actually make it work? And a bonus, how do you actually make it work to where it can pay you in two places at the same time? All right, so let's dig in. Okay, first and foremost, we hear about whole life insurance, right? But let's be honest, whole life insurance, typically when it's sold, it's not coming from your State Farm agent because as caring as they are, like a good neighbor, State Farm is there, right? They're still financial advisors in some way, shape, or form where they're just trying to sell you crap where they make money, but you don't, right? So this is not buying your traditional life insurance policy. This is definitely not term insurance. You cannot borrow from term insurance that way. This is not even trying to use universal life because it can get tricky. There's a little bit of hangups you can have there. This is actually using with whole life insurance policies that we're talking about here, right? We want to see how can we actually access the money and do I have to borrow from it? And why do I have to pay myself interest? You've probably been asking that question too, haven't you? Well, let me explain a little bit more. So again, this is not traditional whole life insurance. When I talk about infinite banking, especially max ROI infinite banking, we try to lower the cost of the death benefit as low as we can go. Where most people just sell you, say, hey, here's the death benefit and here's what you got to pay us. And then you'll wait years and years, 15 to 20 years before you finally have just as much in that tax-free savings account called cash value. You finally have as much as you've paid in, but you had to wait almost a couple decades to do it, didn't you? To me, that's a waste. I did the same thing. I bought a policy believing the same thing, thinking that, oh, and he was, by the way, this guy actually sold me on Infinite Banking by Nelson Nash, right? Like all that kind of stuff. Well, when I started to buy the policy, I realized it was really expensive up front. 2 years later, the recession hits hard. I can't afford to pay the premiums, and I lost my policy. I had paid $25,000 into it only to lose it all. Why? Well, really, let's be honest. All that money was going to pay the agent his commissions and the insurance company their profits, not paying me. That's what was happening. Everything was being paid to him. And even when I confronted him about it and said, hey, you could have designed this better where you could have lowered my costs so that more of my money went to cash, and even if I couldn't pay the premiums could actually pay for themselves. Many of you don't realize this, but you don't have to pay into these policies forever like they always teach you. You could actually get them pay for themselves sometimes after just a few years. You could literally have them pay for itself and not pay another dollar in. But he didn't teach me that. He said, Chris, the only reason I designed it that way is because I couldn't afford to cut my commissions. Why? Because he was paid to sell me crap, right? That's what was happening. I don't want you to be in that same place. And so when I talk about max ROI infinite banking, that's our special process I've spent years developing to do it the right way. You want to have lowest costs, highest returns possible in those policies while still keeping it tax-free. Now, you might be asking, okay, I heard you could borrow from it, but why would I pay to use my own money? Because here's a lie that you'll hear on social media, even on here on YouTube. You hear people say, oh, you borrow from your policy and then you pay yourself back. 100% lie. Total bold-faced lie. In fact, you might even watch that video. It's still a lie. The truth is you're not paying yourself interest. You are paying the insurance company interest. Or if you do it through a bank line of credit, there's insurance lines of credit you can get through banks too. You're paying them the interest. Don't let anybody tell you that that's not the case. It is true, you are paying them the interest. However, at the same time, they're also paying you interest on that money. He's like, well, wait, how does that work? Okay, well, here's how it works. Say you have $100,000 sitting in this policy. You want to access $50,000. Now you can actually withdraw the money. You don't have to borrow from it. You can withdraw the money. Just be careful if you withdraw too much, especially if you withdraw the gains of your policy, they will tax you. This is tax-free if you don't pull out the gains. But you can withdraw $50,000 and just invest, and then your balance drops. Here's the problem though. If your balance drops to $50,000, it's not like that. You have to spend more time to get that money back up to start compounding your interest again. So what most people do, including myself, is I borrow the money from the insurance company. I don't pull it out of the $100,000. It's still all there, and I'm getting paid almost 6% tax-free dividends on that money right now. Next year, it probably will be 6% because rates are going up. But I'm getting paid on that money. All 100,000 of it is paying me. While on the other side, I am paying the insurance company interest, right? Now, here's the nice thing. When you do take out a loan, when you do borrow from your policy, you pay it back however, whenever you want. Your deadline for paying it back is your death. And so the nice thing is, even if you don't ever pay on that loan, right? I mean, now it can compound interest against you. Be aware of that. But even if you do that, and at that point, when you pass away, say it was a $2 million death benefit, you had $500,000 of loans, they're going to take their $500,000 back. They're going to pay themselves back first, but still pay the other $1.5 million to your family tax-free. You still don't disinherit your family, but you're able to use some of that while you're alive. Is that kind of cool? It's a way to kind of disinherit your kids without fully disinheriting your kids. It's kind of nice. So that's how it works for the loans, right? But they are charging you interest. Now, here's what I recommend. if you're going to do that, I recommend paying at least interest-only payments back. Now, you don't have to pay it monthly. Again, there's no minimum monthly payment. They don't even pull credit. And yes, you can use the money for whatever you want. I had somebody saying, well, do I have to give them a reason? No, you don't. You don't have to give them any reason. You could literally take the money out. You can go and blow it in Vegas. And you can go and buy drugs with it. Don't recommend that, by the way. No, you did not hear that from me. I'm not telling you to do that. I'm just giving you an extreme example. You can use it for whatever you want. You don't have to give them a reason. It's your money you can use. Even if you're borrowing it from them, they still know that your money's in there. By the way, the reason that they're willing to do that is because they know your money's going to earn at least usually 3-4% a year, guaranteed. Even if they don't pay dividends, they usually pay at least 3% back in a return of premium. But the truth is, most of them are paying you at least 5 or 6%. So that's why they feel safe, because they know that money is safe over there. They're willing to give you a line of credit against it. And by the way, depending on the insurance company, it can be anywhere from 90 to 95% of the cash you have, you can access and borrow. That's what you can use. Some companies are more flexible than others, but it just, again, it's case by case. Now, many people ask, well, what's the penalty if I take out the cash? Or what if I don't pay it back? There is no penalty. There's not even a finance charge, guys. It is literally just charging you interest. That's it. That's all it is. So unlike a home equity line of credit where they'll charge you for appraisals and whatever other fees, and then they give you the money and then they charge you interest, this is not the case. It's a private loan. Like I said, it doesn't show up in your credit. They just literally charge you interest. That's it. So there's no penalties. There's nothing like that, additional fees. It's literally just their fee is the interest rate that they're charging. And yes, the interest rate can fluctuate. It can go up or down depending on what's going on with their interest rate environments. Right now, one company that we like to use, they'll pay you over 5.5% while they charge you 6.2%. Now, someone might be asking, this kind of leads to my next point about, Chris, you said this double dip thing. How do I make money in two places at once? Well, Chris, wait a minute. If I'm borrowing at a higher rate than what they're paying me, how do I make money? Here's how it works. Now, I talk about compounding interest and simple interest. Naturally, the money that they're paying you is compounding and growing inside that plan, right? It's growing inside that savings account, that cash value. Well, it's compounding and growing there. Now, you've probably seen it before. If you have $100,000, you get paid 5%, you have $105,000. Well, the next year you get paid 5%, that becomes $110,100 or whatever it is, right? And then the next year it becomes like $115,000, so many hundreds of dollars. And the next year it's like $121,000, then it's like $127,000, all that kind of stuff, right? You've seen how compound interest works. It just kind of goes and exponentially keeps climbing. Well, the opposite is true when you borrow. Now, if you do pay towards it, it does not compound against you. It becomes simple interest, just like when you pay on any loan, even your car loans, everything else. You ever notice that as you pay down the loan balance, more and more of your payment goes to principal, less and less to interest? That's not a scheme that they're doing to try to rip you off. That's literally just math. As you pay down at least interest only, right, the interest doesn't compound against you. So what I recommend is if you're going to borrow from this policy, use it for something that you're going to be able to either make money from it to pay it back in, or something you're already going to be paying anyways. So for example, if I go and I pull out that $50,000, borrow it from the insurance company, and I use that as a down payment on a $250,000 property, let's just say I make $400 a month, $5,000 a year on that property, right? Well, I'm going to take that $5,000, I'm going to use that to pay down the principal and interest on that. So I'm going to pay the loan balance down. When you pay the balance down, you get charged a little bit less interest that next year. Say it pays down to $48,000. Now I'm only being charged 6% on that $48,000. Well, the next year I take that $5,000, do it again. Maybe I'm down to like $44,000, right? Now I'm getting charged 6% on that, and so on and so forth. So what happens is that right now on the other side, I'm compounding my money and it's growing faster, but at this time it's going down. There's less and less being charged to me. That's how I can actually make money in two places at the same time. I actually showed this to a woman recently where I said, I used that same 50,000 example, and she realized because it wasn't borrowing all of it, I said, well, look, because the money's still paying you over here, you're still making money here, but you're paying this much in interest here, even the first year you still make more than just having your money sit there and do nothing. Like you actually make more in compounding interest versus the simple interest you're paying to the insurance company. And so when she saw the numbers, she said, oh, that makes sense. But in her mind, she's like, no, it's higher interest rate. I get charged more. No, you don't. Not necessarily, right? All things being equal, if you let them both compound against each other, then yes. If they're both compounding, you're not paying anything towards the loan, then yes, that loan balance will grow faster than the cash you have on the side. It'll be only a little bit, but it'll be growing faster. So that's why I say the best way to make that work is to take the cash flow, invest it back in. And when you do that, because you pay the loan balance down, you make more in compounding interest than you would if you just use a savings account to invest in the first place. You can actually make money in 2 places at the same time. So many people will say, well, how do I know if I already have one of these, or if I'm looking at this, how do I know if I have the right policy? How do I make sure I don't get ripped off by that insurance agent? Great way to do that, guys, is actually the only way you do it is comparing numbers. I actually encourage people to shop us around. By the way, if an insurance agent doesn't let you take home the numbers or see the numbers before you commit to doing it, don't do business with them. Some of them will even wait till you finally get approved of the policy, and then they'll send you the numbers. Don't fall for that little sales tactic. That is not cool. You can get the numbers right away and you can look at them. And I encourage people, good, shop around. You'll see, especially when we do it, that we'll beat everybody else out legitimately if it's actually apples to apples. So I just tell people, listen, if you want to figure out if you're getting the best deal, just go to moneyripples.com. There's an infinite banking section there and click to book an appointment to run numbers and see them live. And then you can actually get them to look. And I'll tell you, hands down, we come out either tying the best or we are the best every single time. So that's why we have no problem giving you those numbers. So go to moneyripples.com, go book a call in the infinite banking section today.